We've had a few takes on gold on this show recently. This is one you haven't heard yet.
One of the big worries that I have is that the U.S. government debt is going to end up driving up interest rates. And in order to deal with the debt, we have to devalue the dollar. That has pushed us really into buying gold-related names. So Royal Gold, which is a royalty company, Agnico Eagle, which is a miner, and Newmont, which is a miner. Those are all three names that are designed to hedge us against the possibility of really a devaluation of the dollar.
That's Jeff Muhlenkamp, portfolio manager for the Muhlenkamp Fund. And in today's Money Life Market Call, he explains why he's high on gold stocks and that it has very little to do with precious metals having run up to recent highs. But before we get to him, Todd Rosenbluth, head of research at Vetify, starts us off by going international with his ETF for the week. And then, in the big interview, David Lau, founder and chief executive officer at DPL Financial, talks about annuities in this marketplace and what investors should be thinking about when it comes to the world's biggest, most successful annuity, Social Security, and how it might be changing in the not-too-distant future.
Fun will now commence.
Yeah, it may not be fun when you're talking about Social Security and annuities, but it is important, and we are definitely talking about something important today. This is Money Life for August the 14th. Thank you so much for joining me. It is going to be a wild day, I think, on the markets because producer prices are out this morning, and the expectation is biggest rise we're going to see for a while. I won't be stunned if that happens. And of course, if we see an increase in producer prices, we had a pretty benign inflation print, but producer prices are another measure on inflation, and consumer prices are backward looking. They literally do a poll of here's a bunch of items and what do they cost, et cetera. They then do the adjustments and all the other things you've heard about in the headlines, but basically it's what were prices. Producer prices is where our price is going, so it is much more forward-looking, and as a result, it tends to lead. So if we get a significant increase in inflation as measured by PPI today, it may change what people think is going to happen on the interest rate side of things. I don't normally make forecasts and predictions because, well, we talk about money every single day, and you kind of find out how much that's a folly to some extent. But I have said I didn't think the Fed would cut rates this year. For the last couple of weeks, I haven't changed. I haven't come on and said, okay, I'm officially changing. I think we're going to get a rate cut. I have said I think it's more likely that they cut now than I thought it was a little while ago. But if we get a big increase in producer prices, then my wager on no rate cuts is a little bit better than it was like a week ago. So I'm going to hold to it until the Fed tells us otherwise, because that's kind of what the Fed has drilled into us. I'm Chuck Jaffe, financial journalist and your host here on Money Life. I want to follow up on something, particularly if any of you got an email from me yesterday that you were not expecting. And you may have gotten it if you've corresponded with me because, well, I was hacked. Now, I talked on this show last week about how I had an experience where all of a sudden something comes onto my screen and I see a mouse moving and I'm like, this is not the normal, okay, wait while an update is happening thing. I went to cancel it, hit Control-Alt-Delete to lock it out and do whatever, and it's literally fighting me trying to keep control of my computer. I did everything you're supposed to do in the light of that attack. I did all the scans, I changed some passwords, I did other things, and I said that it happened again. And the only thing I had not done was I had not necessarily shut my computer off at times when I was not using it, because I use my computer at all hours of the day. And if I am tired and I wind up going to sleep, when I wake up, I want to come down and work. I'm like, half the time I've got things in my head that I wake up and I'm like, oh, let's get this down. So I came down the other day and my computer had rebooted, which it will do occasionally, but normally it doesn't have to because I have turned it off often enough, et cetera. I don't know that that is where things happened or that somebody got control and did this, but ultimately yesterday I wound up losing hours of time because pretty much everyone in my email contacts was sent something that suggested there was some sort of a celebration coming on the 24th of August. So if you got one of these from me, please do not open it. If you did open it or you did try to look at this thing, please run all of your diagnostics, although I will warn you that I ran all my diagnostics and it did not show anything in any scan, but clearly I had been hacked. I am hopeful that things are going to be back to normal, but I'm very nervous about a lot of stuff because when your email address gets tied into spam and like I literally got locked out of my email because Google could check and say there's a whole bunch of unusual activity. And literally, by the way, the first thing I got was a couple of mail notices that things had been returned. And when I looked, it said, I wonder what's been returned. I haven't sent much email. Like whose email did I screw up when I was entering an email address or something like that? It was things from family members from like when they were in college, and they're not in college and they haven't been for several years. And I'm like, what did I send to that address? And it didn't quite click with me. And then I started getting the folks I knew. And when I was doing the interview with Jeff Muhlenkamp, Gail is off this week. She works for a large law firm. She's got a bunch of time because she's worked there for a long time. So she gets to take a bunch of time off and needed to take some. So she figured she'd take a little summer vacation. So I'm like only working half a schedule. And I came back, we had to do the Jeff Muhlenkamp interview. And all this was going on. And I literally am watching at one point as I get something shows up in my mail that says, this has been returned, undeliverable, whatever. And then it tells me there's a second one. And then it tells me suddenly there's 5 in that string. And then it tells me there's 12 in that string. And I'm doing the interview, and then it tells me there's 30. And then 124. And then it got up to 180, and then over 200, and then it was gone. And what had happened was in that moment when all that was going on, I guess that's when Google wound up locking me out of my accounts and whatever else. So under any circumstances, I'm still dealing with it and still trying to figure out the best way to deal with it because I don't know. Nothing's been found on my computer to be infected. And I've upgraded and done whatever, but I had all the packages on. I do everything you're supposed to be doing. So under any circumstances, please, if you've got that stuff and you're thinking, Chuck's doing something in my area, and I will point out the timing, particularly unfortunate because plenty of family members and friends know that Whitney is expecting. She is due today. I don't think it's happening today, but I'm not laying any wagers on that. But today is her official due date, and she, people are expecting they might get a note from me. So the idea that they get something that says, hey, there's a party. This was opened by my sister and my best friend, but it was also opened by people that I haven't talked to in a few years who, know that I like to entertain and thought maybe there was something going on. Yeah, just avoid it. And what a nightmare. And for those of you who don't change your passwords or don't do anything else, I do not know what happened specifically that made me vulnerable here, which makes it that much worse. Because even though all of my friends and anyone who's an acquaintance and plenty of people were like, was this really you? And I was sending messages going, no, it was not me, but I couldn't send them all fast enough because I was locked out of my email account and things along those lines. Even though they all understand, this happens and it's unfortunate, it doesn't make me feel any better, right? I feel really sorry if any of them are going to wind up going through any of this. So please protect yourself. But right now you're here, which means you're trying to protect your finances and do the right thing. So let's get busy. Todd Rosenbluth, David Lau, really interesting discussion regarding annuities and Social Security and more, and Jeff Muhlenkamp with the market call. We'll kick things off with the ETF of the week when we return in a moment.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
One fund on point for today, the expert to talk about it. Welcome to the ETF of the week. Yes, this is the ETF of the week where we get the latest take from Todd Rosenbluth, the head of research at VettaFi. And if you go to VettaFi.com, you'll find all the tools you need to be a savvier, smarter investor in ETFs and to get more details on the new, newsworthy, trending, and timely ETFs that we discuss here. Todd Rosenbluth, it's great to chat with you again.
It's my pleasure.
Your ETF of the week is
The Avantis International Small Cap Value ETF, AVDV.
AVDV, the Avantis International Small Cap Value ETF. Small cap, well, we've been waiting for a small cap rally. International, we've been watching a big year in international, but there's some concern about how that might be changing and what's going on with tariffs. So what's your reasoning for this fund being ETF of the week now?
So a couple of things caught my eye with this Avantis ETF. Through July, it was up more than 25%. For the year, it's outperforming an all-country world small cap index, and it recently crossed the $10 billion mark. This is an actively managed ETF from a proven active manager for folks that want to have overseas exposure. We've talked mostly when we've focused international investments this year on the large cap space. I think we've often focused on the index based or some of the active products, but this is a small cap value fund. So Avantis has a strong record of small and value strategies. This one really caught my eye.
In terms of the international side of things, we should point out to people that we are recording this in advance to accommodate travel schedules. We're just still getting to resolution on some of the tariff things. So this has been recorded more than a week before it is airing to our audience. But I'm curious, because if you're picking this knowing that we've got a little bit of a time lag, you've got to be convinced that we've seen much of the tariff impact, or that we're not going to have anything that is scary, like, okay, as we get some final adjustment here, right? So is part of the reason for international now that we're finally getting some clarity in your mind?
We are starting to get some clarity. The volatility seems to have slowed down. A number of initial trade deals have been announced by the time you and I were talking about it. But smaller companies tend to be more locally based. And so my understanding is the tariff impact is going to be greatest for companies that are shipping to the United States, that have overseas revenue streams. So the smaller companies that you'd find within Canada or within France or within the United Kingdom, to name just some of the markets that you'd get exposure with this ETF, the companies are not the ones you would normally know the names of. These are lesser known, more locally based companies that I think provide some insulation based on the volatility that's going on. And then the fact that this is a value slice, or this is a portfolio that's focusing on valuation, you're finding things that have likely pulled back in advance, according to management, have some opportunities to improve.
You frequently, when we talk about international ETFs, you're frequently banging the drum on investors going, you may not love diversification, but all the studies say domestic investors don't have enough international exposure. Well, if they don't have enough international exposure, they particularly don't have it for small caps. So for you, as part of that thinking, why this fund now? Because we have seen a big run on international. So folks have leaned in a little bit this year. But again, they've been leaning in the sweeter spots, not necessarily the small cap.
Correct. So when I think of what we see within US-based investors' portfolios, their international exposure tends to be more, it's market cap weighted, exposure to the EFA, exposure to the FTSE-based strategies, where the largest companies, the Nestle's of the world, Nestle pops into my head as a large cap developed markets company. Smaller companies are underexposed, we find, within a portfolio, but yet $10 billion is now in this Avantis ETF. So it shows that when investors are turning to international small caps, this is one of the funds that they're focusing on. I think for good reason. The track record is appealing. It's relatively low cost also to get exposure to international small caps. Just 36 basis points is the fee.
I was going to ask about expenses. Again, 36 basis points. We haven't really talked about management. This is actively managed. I mean, most investors, you said they wouldn't necessarily recognize the companies in here, but they wouldn't if they were looking at a small cap international index either. So this is active management that is making the calls on this.
That's correct. So this is actively managed. Just to level set a little bit, the portfolio has over 1,400 stocks. So it's owning the broad array or a broad array of international small cap companies. Avantis tends to have a favoring of companies that have attractive valuations, that are higher quality and have the stability of their operations, and yes, smaller size. So the active management is not heavy handed. This is not a concentrated portfolio favoring a small pun intended, a few number of stocks in particular, but yet 1,400 of them well diversified across geographies and sectors.
What that also says is that maybe somebody needs to be considering what they are getting with this fund from the standpoint that we just were talking about. Hey, maybe you want to get your exposure to international small caps this way. Well, this with 1,400 actively managed, but 1,400 is much broader, therefore maybe likely to have a little bit less volatility than something that is concentrated. If somebody wants to add a little bit more juice in this space, might they want to be looking at something, or at least compare this before they invest to something that has a much smaller portfolio?
So yeah, you certainly want to see the other choices that are out there. International small cap and concentrated don't as easily go hand in hand together from in the ETF wrapper. That might exist. I'm failing to think of one off the top of my head. Many people are underexposed to this space, and I think they should have more, or they should certainly be considering it. In the US, we tend to have a hefty weighting or a reasonable weighting to small cap within our portfolios. I think many investors are missing out. This is a great fund to get diversified exposure, and the active management has been adding value based on its track record. I believe this actually is a 4-star Morningstar rated fund the last time I looked.
It is indeed a 4-star fund. And again, what they'd be missing out on, well, this year, fund up about 27% through July. It's the Avantis International Small Cap Value ETF, AVDV, the ETF of the week from Todd Rosenbluth at Vetify. Todd, happy travels. We'll see you again next week.
Thanks a lot.
Todd Rosenbluth is the head of research at Vetify. Go to vetify.com for more information and to research the funds we talk about, or your favorite funds, or whatever you're thinking might be your next favorite fund. And of course, Todd starts us off every Thursday with the ETF of the week, and we are just getting started. Later, it's market call time with Jeff Muhlenkamp from the Muhlenkamp Fund. But up next, I'm talking about annuities and Social Security with David Lau, Chief Executive of DPL Financial. It's the big interview right after this message.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Welcome back to Money Life, where it's time for the big interview on the August 14th show. I'm joined right now by David Lau. He is Chief Executive Officer at DPL Financial. If you want to learn more about him and the firm, you'd go to dplfp.com. And why you might want to know more about the firm is that we're going to be talking about some stuff that's pretty important, notably annuities. And there's a lot of stuff going on that might make annuities more attractive to you than they've been. There are other things that may make you say not so fast. We're going to get to ask all those questions to David. David Lau, welcome to Money Life.
Thanks, Chuck. Thanks for having me on. Look forward to the conversation.
Let's start just a little bit with the news, because, of course, what we have been hearing in the headlines is that there's going to be some people who are watching what's happening with their Social Security benefits, and Social Security benefits could be cut. But even separate from that, we're looking at Social Security and when they're going to not run out of money, but not be able to pay full benefits. And so there are plenty of folks, among them in my age cohort, because I'm a early 60s guy looking at when that stuff will kick in, who are wondering if they're going to get full Social Security for a lot of reasons. Help us understand, A, what your take is on those things, and how Social Security, which is the greatest annuity program in history, is positioned to weather it, and B, how consumers and investors should pair annuities with Social Security?
Yeah, that's a great question. Boy, wouldn't we like to see our leaders address the Social Security issue? So, for literally as long as I can remember, they've been pointing to this time, in early 2030, 2033, in which they say Social Security is going to be bankrupted. And still, nobody has taken action to do anything about it. And of course, the longer you wait to take action on it, the worse the problem gets. So it would sure be great to see our leaders, on Capitol Hill there make some efforts to make adjustments to Social Security, whatever they may be, to help firm it up. The program's not going away. I feel very confident about that. But diminished benefits are certainly a concern. And the form that might take, who knows? Like it could be lower payments, it could be later ages before you can start taking payments, some combination of those things. But something clearly needs to be adjusted in order to keep the solvency of the program. And the longer they wait to do something about it, the bigger the problem. So, like you said, Social Security, everybody thinks about annuities, and they think about it, annuities being controversial things. And when it comes to academics and thinking about retirement, annuities aren't controversial. They're great products, great product structures, and they provide incredible benefits to end consumers. Ask anybody if they like their Social Security, and of course they do. So then when you look at creating your own personal version of it in the form of a personal annuity, that's also generally very attractive. But for various reasons historically, annuities have become controversial products in many ways because in my estimation, a lot driven around the cost and sales practices, with heavy commissions involved.
Away from the commission side, though, I want to get back to it. We've got an
Yep.
annuity industry where, as I say all the time, no one wakes up in the morning and says, okay, today I need to, fill my tank with gas, get a dozen eggs, loaf of bread, and an annuity, right?
Yep.
Annuities are always sold. But again, most people don't think about Social Security as being an annuity, and that's what it is. If we're going to be using annuities as an adjunct for Social Security, if we think that it's a way that an investor can say, I want to protect against longevity risk and I want to protect against some of the things happening in the government, how do we get them to where they don't feel, regardless if they're being sold a bill of goods? And I know that that's a lot of what you do at DPL in terms of helping folks with the platforms that are low commission and all the rest. But how do we make it that folks don't feel that, this is a product that is being basically foisted on them?
Yeah, I mean, you're right. It's a big reason why I, created the firm, after having built an insurance carrier, it was, to deliver products that are bought rather than sold. So we work with financial advisors who work on fees from their clients rather than commissions. We build low cost, products with lots of the leading carriers in the industry. And then we provide technology that enables consumers to come on and find their own products, without having to deal with a commissioned salesperson. And we've built our tools with kind of the layperson in mind. You don't have to be an annuity expert. You tell us through our technology what you're looking to solve for. Whether you're looking for lifetime income, you want downside protection, the basic features and that annuities provide, and you give us a couple of demographic pieces of information about yourself and what you're trying to do, and we'll show you the most efficient annuity to do that for you, so you don't have to feel like it's being foisted upon you. And the attraction of annuities, people always like the notion of annuities, guaranteed lifetime income. Today, that's more important than ever for one reason that you're bringing up and we're talking about, the uncertainty of what Social Security looks like, but also the extended duration of retirement. Many people can be spending a third of their life in retirement, and trying to fund that simply by being invested in the market is really challenging and filled with uncertainty, and not everybody has the stomach for that. So, annuities and providing very efficient income, they're designed to produce income. So they do it very efficiently, meaning you can generate a lot of income per dollar compared to investments. are very attractive to people looking at funding an uncertain duration retirement.
Investors tend to look at annuities kind of at the wrong time when it comes to rates. And it's not just annuities, it's also things like reverse mortgages. Like at the time when they should be thinking one product, they're usually not, et cetera. So here we are in an interest rate environment where things have gotten better. We've got fixed income paying returns. How would you help somebody navigate where we are, especially when we're expecting rate cuts and what that might do? Like, do people want to beat the rate cut? And if you're thinking about an annuity, do it now, or do you want to wait?
Generally, you'd want to do it in a higher interest rate environment. Particularly like right now, there are annuities, many of which are funded by fixed income and investments, from the insurance carrier. Higher interest rate environments are generally good times to get into annuities. Also a good time to exchange an old one. If you purchased an annuity, in the last 15 years and you did it in a much lower interest rate environment, now is also an excellent time to roll that over into a better product because your product was purchased and built at a time that interest rates were low, so your benefits are probably much lower than you could get today in a better interest rate environment. So to that end, we also have a great tool that consumers can use, where you can upload your annuity statement and we'll give you an instant comparison, to today's, low cost, no load products. So it's a great time to, do those comparisons, and generally a good time in a higher interest rate environment to be getting into a new product.
One of the things that is a barrier to entry for a lot of people is that they think that annuities have to be big. And here on Money Life, we had a time where we were sponsored by Gainbridge. Gainbridge, of course, does direct to the public annuities and does them in small dollar amounts. I'm curious for your take. As we've seen annuities evolve, as we've seen more low fee options and platforms like the stuff you're doing at DPL evolve, does it make a lot of sense or more sense for people to basically build small portfolios with multiple annuities? Because in the past, it would have been like, hey, if you're going to invest whatever it is, 50,000, 100,000, 200,000 in annuity products, it would have been buy an annuity. Whatever it is, do the whole thing. And now it
Yep.
seems to be maybe some of the thinking is, no, you can, do 5,000 now and 5,000 later or what have you. I mean, maybe given current interest rates, you want to be putting more in now, but a number of small annuities adds up to the same way, in a portfolio as that one big one, but gives you more flexibility, right?
Yeah, it can. I mean, not a lot of people do that. Not that it doesn't make sense; it does. But usually, like you're saying, particularly in a sales world, that salesperson selling you an annuity wants you to put in as much money as possible, typically, because that's going to affect the commission that they get. But it can make a lot of sense to do that. But most people don't want to have to go through the annuity application over and over again. And you can see annuities that allow you to have ongoing contributions, so you can open them up with a certain dollar amount and then contribute on an ongoing basis like you would to your 401k or any savings plan you might have. But again, we help consumers make those kind of decisions by building tools that can help you see how far your dollars will go. So if you're looking to, if you have $50,000 or whatever, you might have that you might be thinking about investing, you can use our online tools again to say, I have 50,000, what would be the most efficient product and how much income would that project to generate for me? So then you can solve it from that point of view in thinking about how much do I need to fund into this product in order to get the kind of income that I need. And many people solve from that point of view. Let's solve how much income I need, then figure out how much I need to put into a product to fund that amount.
As for where things are right now, the annuity industry is still having plenty of fights over, how these products are sold and how they are marketed and the rest. And I've seen plenty of bad annuity pitches. Help everybody understand, where does an annuity fit in a portfolio, or should it fit in a portfolio? It is an alternative or a substitute for what? Because I certainly see people who are looking at things like equity indexed annuities and thinking they're a substitute for the stock market, and that does not ever seem to be correct.
That's a great question. So it depends on the type of annuity, but basically the way we think about it is an annuity should really be a fixed income replacement. So even and the names like the types of products you're talking about, the indexed annuities, you get invested in an S&P 500, and a lot of people will position that like you're invested in the market with no downside, and that's simply not true. And it's a little bit confusing because of the naming of the product, but you should expect fixed income like returns out of those kind of fixed products. And we really like them when they're built properly and they're good products, which we make sure we have on our platform, because one of the things a couple of things annuities do for you, as somebody who's approaching retirement, is one, those kind of fixed products provide downside protection, which means you aren't going to lose money due to the market performance. So, when you're approaching retirement, there's a thing called sequence risk, meaning, if the market's down right before you retire or right after you retire, that has a dramatic effect on your ability to fund your retirement, because you start making withdrawals, to fund your income when your portfolio is down. So putting in some level of principal protection makes a lot of sense, for people approaching or in retirement. And then they very efficiently generate income. So you can turn on those income features after getting that principal protection to get a pretty nice payout. But you should expect fixed income like accumulation, not equity like accumulation. Now you can invest in like variable annuities, which means you're invested in the market, you're invested in mutual funds, and those can be accumulation mechanisms. But if you're looking for income, we typically look to fixed products, because you're trying to secure an amount of income you need for retirement. You're not trying to hit home runs in the market. So if you're getting pitched, something that sounds a little too good to be true, like you can get market-like returns with no downside or limited downside, then it really is too good to be true. You shouldn't be expecting that. With the downside protection products, you should be expecting fixed income-like returns, not equity-like returns.
Yeah. And I'm curious quickly, because we're almost out of time. We're seeing a lot of evolution of financial products. And for example, whether it's ETFs and mutual funds that now are using options and what have you to get income strategies. So you've got an options overlay that generates more income and what have you. And then you've got all the other sorts of ways that we can cut it up now. Is that just making everything that much more confusing? I mean, I don't see a lot of necessarily new products coming out of the annuity world, but I see a whole lot of things that seem to be trying to compete with the annuity world.
Yeah, I think that's right. So I think you're seeing, investment products starting to bring in some features like annuities. And the reason is, to me, at least one of the big driving reasons is like simple, portfolio diversification doesn't provide the kind of risk management that it used to. There's so much correlation, within, from fixed income to equities these days, meaning when stocks go up, also your fixed income tends to go up. And when they both go down, one goes down, the other seems to go down. It used to be that they were uncorrelated and kind of the inverse happened. But there's so much correlation now that that's not a lot of risk mitigation to simply diversify your portfolio. You need to bring in some products that actually provide downside protection. And so you can do that in the form, of annuities, or to your point, some of the more recent, buffered ETFs and other products that are coming out that offer, some annuity like protections, within ETF forms.
David, really interesting stuff. I got more questions. I don't have more time, but hopefully you'll come back and chat with us some more down the line.
Yes, thanks a lot for having me on, Chuck, and happy to come back on anytime. Enjoyed the conversation.
That's David Lau. He is founder and chief executive officer at DPL Financial. DPLFP.com to learn more about the firm, what they do, to get their take on annuities and more. And speaking of more, we've got more of Money Life to go, including the market call with Jeff Muhlenkamp from the Muhlenkamp Fund talking stocks. Stick around. This is Money Life.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Jeff Muhlenkamp, portfolio manager for the Muhlenkamp Fund, is here. We're talking stocks. It's time for the market call. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they're putting it all together. And returning to the show today, Jeff Muhlenkamp. He is the portfolio manager at the Muhlenkamp Fund, which is MUHLX if you are looking for the ticker. And if you're looking for more information about the firm and the fund, you're going to go to muhlenkamp.com. Just the same way you'd expect it to be. Remember, Muhlenkamp, Muhlenkamp. Jeff Muhlenkamp, it's great to have you back on Money Life.
Thanks so much, Chuck. Thanks for having me back.
We always start with methodology, and you guys are classic, let's be, active managers, good stock pickers, etc. But more goes into doing it than just that. So explain what it is that is the Muhlenkamp style, if you will.
So Ron developed a proprietary method of valuing stocks back in the 70s, and the primary inputs are return on shareholder equity and the inflation rate out there in the economy. And we use that model to screen through about 2,500 stocks a quarter. And that usually gives us a short list of companies that are interesting, which means that they're selling at prices below what that relatively simple model indicates they ought to be worth. So that leads us to a short list. We start investigating those companies, trying to understand the environment in which they operate, what they're trying to do, how they make their money, and really whether the prospects for profits in the future are better than they are today or worse. And so we go from there.
When we've talked in the past, there are times when you are a little bit more on the equity side. You like what you see. There are times when you're a little bit more cash. Where are you right now in terms of being able to find values with a market that's gotten back to record highs?
We're finding values in a couple of industries that we think are at kind of cyclical lows. So if you look at the chemicals industry and you look at non-AI computer chips, both of those industries went through a boom, they went through a bust, and now it looks to us like they're starting to turn up just a little tiny bit. Which is kind of classical, play the business cycle kind of thinking. And so we've put some money to work in those areas. We haven't yet, disclosed what we're buying. I'm not sure we're completely done buying, so I'm not going to go into specific names. But those are the industries that are looking really good to us right now in terms of finding values. There's probably also some decent values in the housing industry, but I think you might be a little early yet. And again, that's kind of a typical business cycle. So the housing industry has really slowed down, and home builders are starting to compete on price. And so if they're undergoing a price war, we want to kind of watch how that develops, see where that takes their profit margins before we step in and start buying. But that's also a sector that is of keen interest to us right now.
Since valuation is important, and we had that quick little drawdown in April as we at the start of the tariff tantrum, did that wind up putting things on sale for you? Did that fundamentally change anything? Or is a move like that, and even the headlines with tariffs, not necessarily something that's going to wind up giving you more or less to look at?
There are actually a lot of things going on besides tariffs that are making us think really hard. Kind of starting with an economic perspective, you have what I'll call an AI boom, and maybe it's a bubble, maybe it's not, I'm not sure, but for sure it's a boom. So you've got lots of capital spending by lots of very deep-pocketed companies chasing the AI. That's reflected in the markets, not only in chip makers like NVIDIA, but it's extending all the way through kind of the chain of people that support those chips. So whether it's construction companies that are building out the new data centers, whether it's the utilities that have to spend money now to put into power generation, right? There's a whole swath of companies that are benefiting from AI spending. And in many instances, those companies have gotten to valuations that are really pretty extreme and do make you start to think, gee, is this a bubble? Is this going to burst at some point? How do I deal with that? And so you've got that going on. You've got tariffs going on. And when I listen to companies, we're just in the middle of earnings season. And so you go and you listen to all the CEOs talk about what's going on in their business. It was very interesting listening to people talk about tariffs and how that's impacting their business decisions. And so in some cases, that's causing people, CEOs, to defer decisions because they're not quite sure exactly how things are going to shake out. So they're doing some short-term things, but they're kind of deferring longer-term decisions. But there's another aspect that I don't think has gotten much press that probably ought to, and that's regulatory changes. So there is a broad movement, I think, in government once again. So Trump deleted a bunch of regulations, simplified a bunch of regulations in his first term, and he's doing it again. And you saw that with the one big beautiful bill, right? They actually took away the penalties for violating CAFE regulations for automobiles. So they basically gutted an entire regulatory regime that has defined what it means to make a car in America and to make a car for the American market for probably 50 or 60 years. And we don't know what that looks like yet. But for instance, when I listen to a guy named Rusty Rush, he's the CEO of Rush Enterprises, which is a chain of truck dealerships. Think over-the-road semi-tractor trailers, right? Truck dealerships. And he talks about what that's doing to his industry, right? So there's been a pattern, a cycle to truck buys that have been driven by changes in EPA regulations around emissions from the diesel engines. So every 4 or 5 years, there's increased emissions regulations. And usually what the truck companies do is they go buy the last of the old style engine the last year they can. They go buy a bunch of them because they're not sure if the new technology is going to be very good. And they don't want to be in a position where they have to buy the new stuff and it turns out to be junk and it hasn't been quite figured out yet. So it creates this kind of wave, if you will, of buy the last of the old technology and then pause a year and see what you get. And that creates this cycle in the industry. Well, right now, with the EPA relooking all of their regulations, no one is quite sure if the next iteration of more intense regulations around emissions are going to happen or not. So the manufacturers aren't quite sure what to build, and the truck companies aren't quite sure what to buy. So you have kind of a pause created not by tariffs, not by supplier demand for moving goods and materials in the U.S., but by the potential for regulatory change. So there's all these weird kind of things going on in the economy that you've kind of got to figure out and pay attention to and sort through to see where the opportunity lies and what the near-term risks are. And we're doing a lot of that.
So give a name or two that stands out to you right now as the kind of thing you want to be in given these conditions and those opportunities.
So I'm gonna step aside then to a different set of worries. So we're not going to talk about regulations, and we're not going to talk about tariffs. We are going to talk about government debt, right? One of the big worries that I have is that the U.S. government debt is going to end up driving up interest rates, and in order to deal with the debt, we have to devalue the dollar. That has pushed us really into buying gold-related names. So Royal Gold, which is a royalty company, Agnico Eagle, which is a miner, and Newmont, which is a miner. Those are all three names that are designed to hedge us against the possibility of really a devaluation of the dollar. Regulatory advantages, I don't have a name yet that's going to take advantage of them. What we did do, we had owned Occidental Petroleum, but Occidental, OXY, is in the oil and gas business, and they had been putting CapEx into direct air capture of carbon dioxide. And that was kind of their next profit center. Well, the EPA is relooking their basic finding that carbon dioxide is harmful to humans. And if they change their mind about that, then the billions of dollars that Occidental put into direct air carbon capture is going to be written off. So about 4 or 5 months ago, when I saw that the EPA was doing this, I said, there's a risk that isn't priced into that stock yet. We're going to sell our Occidental because I think they're going to end up writing off what they've been spending money on for the last 18 months, right? So there was a risk that came out of this regulatory change. I can't give you a name just yet for who's going to capitalize on the opportunities that are presented. There's been a lot of interest in the changes in regulations around cryptocurrencies. We're not playing in that because I haven't yet found a good use case for the cryptocurrencies that gives me some confidence in the fundamental need for those tokens. So I really can't go there yet. And I haven't found anybody else that's really taking advantage of regulatory change. Probably still early days, but I have found a couple people that are at risk, and those are the ones I want to avoid.
Well, now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
Come on, it'll be fun.
It certainly is fun when we get to talk with Jeff Muhlenkamp. Also, by the way, I know his father, Ron Muhlenkamp, who started the fund for many, many years. Fun talking with him, too. But if you want to learn more about Jeff and the fund, MUHLX, the ticker symbol, go to Muhlenkamp.com, Muhlenkamp, Muhlenkamp.com. Quick and Dirty, of course, is our lightning round. If you want to get in and test our guests for yourself, send your name, your hometown, and the ticker symbols you're interested in to Chuck at MoneyLifeShow.com. We'll add them to the list. Hope they make it into an interview soon. We're going to start today with a request that we got from Nick in Vestavia Hills, Alabama. He wants to know about Broadcom. It's AVGO.
Great company, too expensive. We sold ours about 6 months ago, probably a little early. It's riding the AI boom. Sooner or later, that boom will turn into a bust. So if you own it, start thinking about when you want to get out and avoid that bust.
It's hold it if you've got it. However, you're actually looking for the position where you're going to be selling.
And now for the profit taking.
And if you don't have it, it's not a buy because it's overpriced. So good company, bad stock on Broadcom, AVGO. Our next request comes from David in Missoula, Montana. He wants to know about TMC, which is TMC, the metals company.
So if you're not familiar with the metals company, what they do is they pick up polymetallic nodules off the ocean floor and process that to get the nickel, the cobalt, and the manganese out of these rocks. Very much a speculative company. I think it's a buy. They've proved out the technology. It looks like the regulatory changes are coming their way. It looks like the movement to make the U.S. a lot more self-sufficient in terms of raw materials has some legs. So, speculative, not flowing any cash yet, but very interesting. And I would take a nibble at it. I think it's a very interesting company. Oh, by the way, I own a little bit personally. Full disclosure there.
That's a buy, but a speculative buy.
Well, I've always been a risk taker.
Like if you've always been a risk taker on TMC, the metals company, ticker TMC. Lance in Bethlehem, Pennsylvania is in on our final three requests today. He shares the first with Mark in Eagan, Minnesota. Very different kind of metals company when we're talking about FNV, Franco-Nevada Corp.
Franco-Nevada Corp is a royalty company. It's the biggest royalty company. They invest primarily in gold streams and royalties. Priced at a premium because they're the biggest and the oldest. But if you buy them now, and I recommend you do, you've got a free call option on a big mine in Panama that shut down a year or two ago and took an axe to their price. Plus, you've got exposure to the gold price, which I like for the reasons I talked about a little bit earlier. And once again, full disclosure, I own it personally.
You've already heard Jeff say even before this.
I love gold.
Yeah. And in this case, Franco-Nevada, FNV, is a buy, even though he pointed out premium price there. So I'm going to ask, Jeff, since you did say you own it, et cetera, but you had talked about Royal Gold and Agnico and Newmont. Is Franco-Nevada, because it's at a premium, less attractive than the others?
I would give it's kind of a coin toss. I think they're all good companies. I think they all have similar exposure. Royal Gold just got knocked down 10 or 15% in a day when they announced that they're buying Sandstorm. So any one of, Newmont 6 months ago had a disappointing earnings call, was down 15 or 20%. So any one of them on any given day or in any given week might sell off for some reason. but I wouldn't hesitate to buy any of them on a dip like that to give me the exposure to gold. I think they're all good companies. They're all nice and liquid, and you'll do fine, assuming gold continues to go up. That's really the underlying bet there.
And again, it was a buy on FNV, but previously we had talked about the others, Royal Gold, Agnico, and Newmont. Lance, I said, is in our last three requests. This one he shares with Dave in Jacksonville, Florida. They both want to know about NVR Incorporated. Its ticker NVR.
NVR is a home builder, probably the best of the home builders in terms of a return on capital, which gives them a premium price and has for many, many years. I think you're near the bottom of a cycle in housing, so it's useful to be looking at all of the home builders. Might be a little early right now, but I would certainly put NVR on my buy list, watch it reasonably closely, and look to pick them up here in the next, 3 to 6 months. Full disclosure, I own that personally too.
Jeff owns it, but what you actually heard in there was like a soft buy because he is looking at maybe getting a better price. So if you don't already have it, you might want to wait a little bit. Either way, it is a buy, maybe a cautious buy.
Buyer beware, dude.
On NVR, ticker NVR. And last, this one's for Lance in Bethlehem by himself. It's United Health Group, UNH.
United Health is struggling. They've been investigated. They've restated their earnings. They've delayed their guidance. I think they fired their CEO. We sold ours about 4 or 5 months ago. I think it's too early to go sniffing around that company. I think there's likely to be more bad news ahead. I'd stay away from it. Maybe keep tabs on it a little bit because Fallen, it was a great company, and they probably have problems that they can fix, but you haven't quite heard what the full scope of the problems are yet. So first you have to find out what the problems were, then you have to hear what the solution's going to be, and then you have to wait to see if their solutions are starting to take hold. That all takes time. Not enough time has passed, in my opinion. Stay away from it for now, but pay some attention. Things will probably turn around for them at some point, and that will be the point you're looking for, but it may be a year or two away.
Yeah, so you're waiting at the best, but in the meantime...
Well, maybe it's time to sell this.
Probably time to sell UNH, United Health Group. That's what we heard there from Jeff Muhlenkamp. And what we heard throughout was great stuff from Jeff Muhlenkamp. Jeff, always great to chat with you. Thanks for taking the time. Let's do this again in the not-too-distant future.
Sounds good, Chuck. Thanks again for having me on.
That's Jeff Muhlenkamp. He's portfolio manager at the Muhlenkamp Fund, MUHLX, the ticker symbol. Go to muhlenkamp.com for more information on the firm and the fund. And for more information on some of the stocks Jeff was talking about, stick around because I'll tell you where he agreed or disagreed with some recent guests. We'll let you know what's coming tomorrow and beyond as we cross the finish line in a moment. Back to wrap this one up. I hope you enjoyed that conversation with Jeff Muhlenkamp, that thing I pointed out at the beginning of the show about gold and his gold comments, given what we heard from Tom Windmill, from the Midas Fund, Midas Discovery, and then from Carly Garner, right? Totally different take on gold. Buying, but with a very different look at what's happening and why. I'll also point out that during Quick and Dirty, Jeff Muhlenkamp talked about UNH, United Healthcare, firing its CEO. And that took me aback for a moment because UNH, of course, is the company whose CEO was assassinated earlier this year. But then I remembered, and I was thinking, fired him? Wait, he was, no. I did remember they did change CEOs in late June. Basically, they moved in the guy who had taken over in the wake of the tragedy, and they moved him out. So if you were taken aback by that as well, and maybe you weren't, well, that's what he was talking about. Now, during that interview, there was some crossover. I was surprised we didn't have more crossover on the mining stocks because we didn't. But Occidental Petroleum, which he had sold, Elliot Gue from Energy and Income Advisor was holding it back on February the 20th, and he was buying Ovintiv instead. Then we got to Quick and Dirty. Broadcom, AVGO, was a good company, bad stock today. Greg Halter, Director of Research for Carnegie Investment Council, had it as a buy on March the 27th. You had United Health Group. It was a sell today. Hank Smith from the Haverford Trust Company sold it on July the 15th. Mike Bailey from FBB Capital was buying it back on April the 3rd. Tomorrow, Eric Stein, Chief Investment Officer at Voya Investment Management, Matt Freund from Calamos, here for the Navigator segment, and more. Plan to be here and lock us in. Meanwhile, if you're looking for something to celebrate, well, today is Social Security Day. August the 14th, 1985 marked the 50th anniversary of the signing of Social Security. And they held a big ceremony, and they tried to make it Social Security Day. So I'm pointing this out because it may not be Social Security where you live, Social Security Day where you live. Legislation was put in 1985 to make it that way, but it didn't pass the Senate. And so there were some local proclamations, and only one state, actually, that I'm aware of, made it a law that we would have Social Security Day on August the 14th. That state, however, is Massachusetts, Commonwealth, actually, and it's my state. And so, yeah, we've got to celebrate the fact that we do it here. By the way, Social Security was passed in 1935, so now 90 years ago, intending to combat poverty and the effects of unemployment, to provide financial stability in old age, and to reduce burdens on widows and fatherless children. That was its initial purpose, worth remembering as you think about what is happening to it today. It's also National Financial Awareness Day. I think you guys are aware of your finances every day, or you wouldn't be here. It's National Wiffle Ball Day.
Play ball!
I got a group of friends. They've actually been playing wiffle ball. They do not invite me because they've been playing wiffle ball together for like 25 years. They're now all in their late 50s and 60s and what have you. And yet every 2 weeks they're playing wiffle ball in this guy's backyard that he turned into a wiffle ball thing. And it's this very closed, private kind of group, but they still love it. I get it. It's also National Tattoo Removal Day, and it's National Creamsicle Day on the food front. When's the last time you had a creamsicle? My guests today were Todd Rosenbluth, the head of research at Vetify, which is online at vetify.com. David Lau, founder and chief executive at DPL Financial, dplfp.com. And Jeff Muhlenkamp, portfolio manager for the Muhlenkamp Fund, Muhlenkamp, Muhlenkamp.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from Jeff Immelt, the corporate executive, who said, "I have learned that nothing is certain except for the need to have strong risk management, a lot of cash, the willingness to invest even when the future is unclear, and great people." Well, yeah, if you have all those things, you got a pretty good recipe for success. However, you still got to keep your finances and your financial life in perspective. So remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Another day, another nickel.